Hi, welcome to this Friday webinar. Every Friday, we have been trying to learn, the context of equity markets, economy, valuations from various fund managers. And over last, I think almost 45 days, markets have cheered us. Equity markets have been up to making new all-time highs every day. Today has been a first day after I think consistent rally upwards where markets have actually kind of shown little pause. In fact, even today many stocks have been up. It's only that IT sector has kind of shown some kind of resistance. So, we want to discuss a bigger thought here with Bhavin Shah, who is, our speaker and guest today for this webinar. Bhavin Shah represents Sameeksha Capital. He's the founder of Sameeksha Capital and comes with almost, I would say, 3 decades of experience. And he, is he comes with IT as his main, forte, and he has designed entire investment thesis and process using I would say artificial intelligence and machine learning. And obviously his product Sameeksha Capital's PMS has delivered consistent returns, and more importantly it has taken lesser risk, and on risk adjusted grounds it actually does really well. So not getting into the product, but this is more of a conceptual webinar where we want to understand from him at this juncture where markets have actually rallied and made all-time high. How does market look like in terms of valuations? Because obviously that there is this thought which even I have in my mind, that I want to maybe add more to equities. I think I have missed the rally. I think I should book my profits because we have seen the factors around us, be it maybe recessionary fears or be it interest rates, all these kind of macro factors are still prevailing. But in between, and we also know that when interest rates are high and there have been these kind of inflationary risks, there could be a possibility that quarterly earnings that will start to now come soon may not be as expected. So keeping all these factors in mind, we want to understand in the overall context, first of all, from you, Bhavin, where do you see kind of market in terms of valuations? And then obviously we'll deep dive sector wise, index wise, and we'll try to understand what are those areas which have become overvalued and where there is still a lot of room for investment and potentially creating wealth through investments.
Okay, thanks, Kamal. So I think so. We look at market valuation in context of multiple things. There are multiple factors that affect market valuation. One is interest rates. Second is how profitable are the companies. Third is the direction of economy and anticipation of growth. Fourth is inflation. What is the direction of that and obviously within that some of the key components that affect inflation. They also relevant is the health of financial sector, because the financial sector is one that funds a lot of growth through lending, and how strong that sector is, because lending, credit growth is important to the growth in terms of funding the projects and so on. So when you look at all these factors, first and foremost on the very most commonly looked at parameters of market valuation, that is P multiples. We are certainly above median P multiple for say Nifty. I can say if you take sort of anywhere between say 0 and 100 in terms of percentile, we are like at a 2/3. So we are above a median, a fair bit above median, but we are not in a pure what I would call a bubble territory from a P multiple perspective. However, on a price to book multiple, which is the market cap to net worth of companies, on that metric, we are definitely near the peak valuations. That has to be put, however, in the context of, as I said earlier, multiple factors matter: interest rate and return on equity that the companies are earning, and what are they likely to sustain that or not. On that metric, which combines the valuation multiple on a price to book with versus return on equity and interest rates, we are above median level. We are again above say, halfway level, but not in a bubble territory. There is also bond yield to earnings yield ratio that is popular, and I think on that basis, actually, we are reasonably placed as well. So another thing one can look at is market cap to GDP, and I think I think we're close to 100%, on a ratio of 1 almost, and so that is by historical standards that is above median. But I think given what is happening in India and outlook for Indian economy, and in a larger context, I think that is not unreasonable. I think U.S. market cap to GDP is now almost 2. So if I just to put it in context. So all in all, yes, valuations have risen, but I think there still remain pockets of opportunities. With this kind of valuations, it is one thing is for sure. Any kind of negative news can have a very quick impact, as it was the case today with the IT sector. And there could be other news that we are not anticipating, and if that comes as a negative, the market can take a little bit of correction. But it is likely to be short term in nature. So I think it will really depend on investors' horizon. I think from a short term perspective, the risk reward is certainly little less attractive, one can say. But the long term kind of fundamentals for Indian markets and economy, and I think it's like sometimes it's like a cliche when everybody talks about that, but I genuinely feel they are quite strong.
Sure. So obviously, all of us are bullish on India as economy, equities and asset class in long term, and that's absolutely right thing to kind of remember. But at the same time, obviously we discuss all those things in almost all webinars. In this particular webinar, we want to understand from you more on objective aspects, and maybe in terms of, say, to begin with, since you come with IT as your forte, we have seen over last 2 years IT sector going through deep correction. If we say Nifty today is at close to all-time highs, Nifty and IT sectors are certainly I think in gross terms 30% from the all-time highs. If I talk about large cap stocks like Infosys, TCS, they are absolutely 25-30% down from their last highs seen in say 2021 mid. Now, obviously in these 2 years, these companies have added some earnings also. We have heard these companies kind of doing kind of a lot of, I would say, reduction in their workforce also. Absolutely. At the same time, there have been a lot of buzz around, chat, GPT and all that, leading to a lot of possible problems for some of these large IT companies. And today, these stocks were down after they rallying for almost, I would say, 10% from their lows. So what is your view with regards to IT sector in terms of valuations, attractiveness, earning growth from here on?
I think what happened is that we were, the IT sector was sort of seeing a mid to high single digit growth before COVID. It had kind of started to settle that, and I think everybody had started to expect or settle with that, and expectations were set there. Then came COVID, and then came a huge opportunity for the IT sector, and I think we saw acceleration in growth. We had a couple of fantastic years, and I think you also saw some of the experts predicting this to continue for another 3 years, a new era for IT sector, digital era, this, that. Some companies also made such strong comments about the future growth, and so I think the valuations, at least in the context of the IT sector, did go a little out of line. And I think that has, that's why we have seen this correction. The other thing that has also happened is that because of the wage pressures that we saw, the margins also corrected. So there is, one was the impact, the hit on the growth that we have seen, and second is the hit on the margins that we have seen. The margins had expanded, and they, and then with the wage pressures, they've also corrected. So all this has sort of come into play. Now, recently, obviously, people started to get back into the sector, but then I think what is very clear is there is still some bit of hesitation / uncertainty with respect to decision making that large companies are facing. And I think you talked about some of the recent technological innovations. The generative AI suddenly came from sort of left field, and so everybody started thinking, hey, well, how does this change the way I spend money on technology? And when that happens, there is always some bit of pause that takes place. And on top of that, there is also a concern that's still out there that maybe while we haven't seen a recession in US, the risk of a significant slowdown is still there. And so all that kind of is playing into the decision making. And I think as a result, that's why we saw the lowering of the guidance by Infosys. And I think we have also seen lackluster numbers from other large cap IT stocks. And that's why I think this is the reaction. And I think it is now we are at a point where I still think that risk reward is not very clear. I think there are times when one can be very confident of investing in the sector. And I think we have done that a couple of times in the last 3-4 years. But today, I think there's a little bit of uncertainty. And so I would be hesitant to put new money into the sector, even though I know that in the context of the Indian market, and this is very important, I think IT sector remains still undervalued compared to many other sectors. Because most of these companies generate tremendous cash flow, and equally importantly, they return these cash flows in form of dividend and buybacks, which is not the case with many other sectors. So I actually don't think IT sector is, there is a valuation challenge with respect to IT versus other Indian sectors. But yeah, growth uncertainty might they will prevail in terms of the share price performance. And I think one has to see some bit of clarity or far more attractive valuations before committing large capital to the sector.
So within your portfolio, are you kind of adding IT at these levels, holding IT at these levels, or you will wait?
So let's see what we did with this sector over the last 3 years, because that is kind of important to give the context. We went aggressively into the sector at the early stage of COVID because we saw valuations that we have not seen in a very, very long time. And we were bullish on the prospects for these companies because of COVID. At some point, we reduced that exposure after seeing a big rally. And then I think we started to be selective. So in last year or so, 1 or 2 large cap IT stocks have significantly outperformed. And I think they have outperformed not because they have delivered amazing results, but because they were much more attractively priced. And so we actually participated in that. We also found 1 or 2 opportunities in small cap IT. And I think, some companies going through significant transformation in business, and versus that, very low valuations. So we participated in that too. If you ask me what we are doing today, actually, I think we prefer to we are more inclined to trim positions in large cap IT today. I think not keen to go in right now. In the small and mid cap space, it's really company specific. So I think if you find something interesting, we might consider investing, but that would be based on very, very company specific factors.
Sure. Another important sector, that has actually created a lot of buzz recently during COVID times was pharma sector. That also post-COVID has gone through a lot of correction. And that sector also is a sector which is part of, you can say, something like, defensives or consistent earnings growth, potential, like we say, for IT. So what are your views, at these levels in terms of valuations or earning growth possibilities overall in the context of, pharma sector?
So I think, pharma is a difficult sector to invest in our view. The variables at play, whether, now obviously you have to segregate pharma into, maybe 2 or 3 different buckets. There is obviously the companies that are participating in the generic opportunity, global generic opportunity, strong, obviously dominantly US, but other generic opportunities. So exporting into that. There are companies that may have contract manufacturing type of business, and then there are companies which are more domestically geared. And we have actually, participated primarily in the domestically geared pharma opportunities, and we continue to have an exposure there. And those companies have also actually performed well for us, because I think in those cases we are able to get a handle on what's happening a little easier than trying to really keep a tab on what's happening to this whole generic story, price competition, consolidation, or whatever else is happening in the in the US markets, for example, and then the whole risk of US FDA, basically approvals and so on and so forth. Now, I think in that context, one or two companies might have actually started to deliver very consistently, especially those who are getting into some more complex part of the story and have been working on it for long term. And maybe we would like to revisit that at some point. But I think the approach of being a little bit more domestically focused has worked really well for us so far. And I think we might continue to do that.
Sure, Bhavin. So, IT and pharma two sector, which were important, we have covered your views on those. Third important sector, before maybe we move on to other finer questions, is financial services. It's a heavyweight sector, and obviously we need to cover this sector as well in terms of your views, in terms of valuations. And then within financial services, obviously, there are private banks as well as PSUs. PSUs have actually delivered quite good returns after a long time, over last 1.5, 2 years. So I wanted to cover, this aspect also, private versus PSUs, while you cover, the financial services sector.
Right. So I think obviously financial services sector, we have to talk about, obviously there are banks, there are NBFCs, there are within NBFCs, there are different, there are specialized NBFCs, there are general NBFCs. I mean, there's many different ways to slice and dice the sector. Obviously, you talk about private versus public sector PSU. Now, see, I think the great thing about this sector is that there is a lot to choose from. And I think because there are so many companies, I think if one is willing to spend time in understanding a particular business in great detail, some gems can always be found. Our observation is that in a rising economy, in a stable economic environment, NBFCs, especially specialized NBFCs with a strong niche, tend to deliver superior growth. Obviously, one has to be aware of the risk involved with respect to, if there is a recession, they might be affected. How secure the book is and so on. But so we are definitely interested in specialized NBFCs, and I particularly like what I find particularly appealing, that even today there is a big gap big sort of demand supply gap in need for funding versus availability of funding at the reasonable cost in the sort of the bottom of the pyramid segment, if I may say so. Very, very small enterprises, their alternatives are often the money lenders. So any financial sector player which tries to formalize that and tries to basically target that segment, I think, and tends to enjoy phenomenal profitability without taking undue risk. So we are really interested in that space because I think the opportunity there is quite big, and that also includes affordable housing, obviously. As far as the overall, I should also talk about the financial sector overall. Actually, the valuations, while that sector has also rallied a bit, valuations are still quite reasonable. I think the balance sheets obviously are the strongest that they ever been. I think there are data that are out there showing how NPA situation is. That it is the best that it has been in over more than 10 years. And I think even PSUs, today also some PSU banks reported fantastic numbers. ROAs, return on asset, a very important metric that is to be tracked, reaching 1 in some cases. So I think there is an overall improvement in health in that sector. Now, there are some pockets of concern, maybe perhaps, I think delinquencies in unsecured credit, credit cards or personal loans. So one has to watch out for those as well. But overall, I think it's a sector that seems to be poised for strong growth and a lot of opportunities. We have historically kind of shied away from public sector banks, and I think we can maybe because we're still not we still feel there is a bit of a risk associated with them if there is a change in the the whole top-down sort of directives, and a change of government can also bring some major change. All the good work that has happened can go away in a relatively short time. So I think we have sort of been shy, but I think we do have some investment in banks which are not exactly public sector, but you can say quasi public sector bank. And so I think we are investing in across all segments of the financial services, private sector banks, public sector banks, large private banks, small private bank, and also NBFCs. So it's a sector that we continue to see a lot of opportunities.
Also, basically, you see a lot of potential opportunities if company is selected rightly in financial services,
Yes.
as well as in long term IT looks very attractive to you. And obviously, after this correction, even within pharma, you see, especially in the mid cap space, there are certain companies which kind of are attractive. And moving on from here, what are your views with regards to auto sector? Because auto sector is something which has been kind of an attractive sector till 2015, but after that, obviously, it just went out of favor. And I don't see any portfolios, be it mutual funds, be it PMSs, having any kind of allocation to auto stocks. Very recently, I have started seeing some portfolios adding stocks like Tata Motors, Maruti, and beyond that, I don't see any stocks in auto. But obviously, we know a lot of disruption is happening, and hence EV is something which is trying to disrupt this sector. And in that context, there could be a lot of mid cap companies, a lot of small cap companies which could be attractive. And you are sitting in Ahmedabad, where obviously there could be many such attractive opportunities which you may have studied. So what are your views in this context, when we know that markets kind of have made their all-time highs and investors are looking for alpha as their requirement? As a fund manager, do you see auto as one sector which maybe probably should be seen more closely to identify some small caps or mid caps to ultimately maybe have some allocation in the portfolio, or you have some other views?
We have invested in auto sector from time to time, and even today, I think we have some auto sector component names in our portfolio. And we primarily, I think our approach is that we want to understand, we want to invest in companies where we are not trying to be very intelligent about some of these disruptions. If it's even with a transition to EV. There are still many components which are not affected by them, and if you can get exposure, to a company with a strong presence in such component and having a market leadership, and otherwise good governance and good focus on profitability, maybe the money can be made from a long-term perspective. So we continue to have such investments in some of the auto component names. We have in the past also owned the OEMs as and when appropriate, and I do think that I think you mentioned some of this domestic. I mean the India listed auto OEM, four-wheeler OEMs, and I think many actually I think it's a very good moment for Indian auto industry in that sense that they all seem to have a good story to tell actually, and I think whether or not they make sense from valuation is a different matter. I think our focus on cash flow and valuation measures may prevent us from owning some of them, but the growth, the product pipeline story seems very favorable actually for many of them, the India listed, the four-wheeler guys actually. So I think ultimately though auto sector, I think the overall growth rates are not going to be very exciting. Whichever product you look at, four-wheelers or two-wheelers, and in commercial vehicles, they all are relatively low growth rate stories from here on. So that has to be built into the valuation and the decision should be taken. So all in all, for us, it's a low exposure right now to the auto sector.
We saw, specialty chemical sector coming up from nowhere
Yes.
for the last 7 years, and it kind of generated a lot of wealth. And today, maybe specialty chemicals is struggling because of, I think, margin squeezing, competition increasing, and we have seen many stocks actually kind of falling 15-20%, like SRF, Deepak Nitrite, and many other stocks have fallen, Aarti Industries and all. What are your views on specialty chemicals, specifically, for maybe upcoming quarters in terms of expected earnings? And then are these levels attractive after the recent correction, or you're kind of still having maybe not a very clear view and you want to wait and watch?
So I think the if there are, if we talk about pockets of gross overvaluations, and there are many, I think definitely chemicals remains one. I think the chemical story got sold a little too hard. I think everybody thought this is the pot of gold that we want to chase. And I think a lot of these companies also reported fantastic results during COVID, various disruptions, China being out of the equation and so on and so forth. And so I think people stopped, people forgot what is genuine normalized earnings and what are inflated numbers. That story is still, I think, not fully deflated yet in that regard. And in the meantime, I think the latest we hear is there is still a lot of slowdown, say, especially from Europe, maybe a little bit from US as well. And so I think the demand outlook is still not very, very clear. I think so I think one has to be very careful. I think from a long-term perspective, there is a lot of growth in this sector that is going to come our way. There's going to be opportunities to make money as well. But whether we are seeing sort of reality, come into the sector, I think it's still not there.
Sure. So, if anyone gives you, obviously, you must be getting investments every day, every week. So now at these levels, how are you deploying money? What are your cash levels? And, how will you invest from here onwards in your equity portfolios?
So, we obviously have both PMS and AIF. We are for older portfolios in PMS and for AIF, we are actually quite close to being fully invested. We will have very low cash levels as of now. I think it's like less than 5%. However, in case of PMS, because we are not following a model portfolio approach, we only buy stocks which are still available at a price below which we think it makes sense to buy from a 2 to 3 year perspective, where we can expect to make decent returns. So when I look at the stocks in our invested universe, maybe something like, say, 20% or so of our portfolio is still at a price where we would like to deploy new money. So I think, so new accounts that are open, 20 to 25% maybe is going into, actual investments. And the remaining is being parked, waiting for the right price.
So what is the, context in terms of large cap and mid caps and small caps in terms of valuations and potential opportunities and attractiveness when you read it with your lens, which is like you try to find out growth businesses at reasonable valuations, and you're an absolutely value conscious fund manager. We have seen, obviously, this argument that now if Indian economy from 4 trillion has to grow to 6 trillion over the next 4 years, obviously large caps will participate, and hence many expensive large caps may remain expensive and may keep showing growth, and we popularly call them as maybe consistent compounders. And they again, in last 2 months of rally have participated, but still obviously they remain expensive. What are your kind of thoughts and views if you were to kind of select and create a new investors portfolio between large, mid and small from here onwards?
So Kamal, we follow some rules around how much we want to have in basically how much is the upper bound on having, say, small cap in the portfolio based on the liquidity considerations. And so, that while we don't have any fixed percentages between mid, small and large, there are some boundary conditions that we follow, from a liquidity standpoint. In that context, today we are probably at the upper end of what we can have in small cap. It's close to 2/3 of the portfolio is in small cap. I think that's a higher number than we have had in the past, and that I think is a function of the fact that the small caps were grossly. They had been penalized a lot. Even today, even if you look at a P multiple perspective, they are still below the median P multiple for the small cap index. Although on a price to book basis, they are close to their peak valuations. I think there is a lot of interesting opportunities in small cap that have emerged, and I think we continue to see a lot of new listings, and so that space remains rich for stock picking, and we will like to continue to participate in that space. And I think, however, if we do find some opportunities in large cap, we would not. And I think, we are looking at some opportunities in large cap as well as we speak. So there is probably a potential for us to shift a little bit away from small cap in the new portfolios because of the opportunities that we see. So I think I would like to distinguish here that the existing portfolio is 2/3 small cap. As we construct new portfolios, there might be a slight shift towards the large cap. But I think we won't be buying something just because it's a great growth story. The value has to make sense to us, because I think what we have understood is that if we stick to that discipline, in the long run we deliver superior returns. Whereas if we buy purely based on sort of the names and the kind of the quality aspect without considering the value, we can have significant period of underperformance, as we have seen for some of those portfolios.
Sure. So what are your kind of, I would say, suggestions or maybe a piece of advice to investors who are sitting with liquidity and who see possibility of adding more to equity as per their asset allocation and have clear 3 to 5 year view? What should they be doing at this juncture, after having seen market rallying and not been able to kind of enter into it? And now obviously today markets have corrected. Maybe markets I'm not saying you can predict what's going to happen on Monday or next week, but still I'm sure you put yourself in that investor's shoe and kind of give your piece of advice.
So I think my view is that because of the move that we have seen in the market, it is prudent to be a little cautious, but not kind of go into a shell. Because the direction for our economy is very positive. The kind of data set that we are seeing on various indicators, I think we have rarely seen inflation is at a reasonable level. Wholesale inflation is actually down quite a bit. So I think the risk to the interest rate increase is low. We don't know whether interest rate can go down from here. That may take a while, but at least the risk to the upside is low. The government's, the fiscal situation is very strong. The tax collection remains very buoyant. You look at the indicators of industrial activity; they all point to a robust picture. The financial strength of the balance sheet strength of the financial sector is extremely strong. So the ability to lend is very good. So there is a whole bunch of positives. The negative, obviously, is the export story. With what's happening in Europe and to some extent US, we have weak numbers coming from exports. But at the same time, the crude prices and so on are reasonable. So I think all in all, it points to a robust economic outlook, especially when we consider the investment that has happened in infrastructure, because those things to have kind of multiplier effect with some time lag. And so I think we might see that in coming years. And I think, if there is more of the same with more investments happening in infrastructure, I think we can, look forward to a very robust India story. So with that context, I would say that, yes, maybe you do, go a little gradual in deploying your capital into equity market over the next 6 months, or maybe take keep a 6 to 12 month horizon. and deploy on a partial basis on a, and obviously if you see a, meaningful dip, say, 10-15% correction, then you can get more aggressive. So that's would be my, suggestion, not having any kind of a crystal ball on exactly when, what market we might do.
Sure, Bhavin. Moving on to maybe, I would say final part of our conversation. You had also mentioned in the very first, part of this webinar, comparing market cap to GDP ratio, which is one of the Warren Buffett's, valuation metrics, saying that India's market cap to GDP ratio is 100%. And this is something obviously which looks kind of concerning and not maybe makes market attractive, though we have seen market cap to GDP ratio going above 100 at 120 levels also in the past. But you also mentioned that US market cap to GDP ratio is 200. Now, which is something which kind of makes me ask this question: why is it that still we see many investors, including you yourself, I know that, still bullish on US markets, and I see many investors who kind of still keep putting some money to US markets, and they say that it's for diversification, though obviously in terms of valuations, if we follow that market cap to GDP ratio, that kind of conveys it's kind of very expensive. And at the same time, I also see many fund managers saying that if compared to other markets, Indian market is not very attractive. There are other markets which are more attractive, but considering this ratio, US market looks to be very expensive. So this kind of definitely raises a confusion in my mind, and hence this question to you.
Right. And in fact, I should correct myself. The market cap to GDP for US, at the most recent, the 30th of June it was a 2.4 actually, not even 2, 200% means 2. So it's it's a max has been 2.5. So we are definitely near that max. And I think if you go back to in the past, where the median used to be around just below 1 actually. But this ratio has kind of remained high. It seems like it's in a new zone, and I think maybe one aspect one has to consider is today, and I think this is some work that maybe we need to do, is that today a lot of US companies have huge global presence, and a lot of their earnings are coming from outside US, and especially the tech sector, obviously caters to the entire world. So in that context, maybe US market cap to US GDP is not the right indicator. Maybe one has to look at the global GDP, or maybe some revised measure to take into account the fact that a lot of earnings for these companies are coming from outside US. And that brings me to the other important point, is that the US, I think the opportunities to invest in globally competitive companies, I think are phenomenal when we look at the US market. You not only get to invest in some great US companies, and this is across sectors, not just technology, which obviously is the most popular, but also industrials, financials. We talked about pharma earlier, biotech, across so many sectors. So it's and then on top of that, you have globally competitive non-US companies also listed there. There's been a lot of talk about semiconductor industry coming to India of late, and obviously the top semiconductor company in the world in terms of manufacturing and is TSMC, Taiwanese company, and that's listed in US as well. You will also get an exposure to some great European companies, and so I think that's what US market offers to you. So while yes, valuations in US have also risen, I think I would say that we are probably kind of in a similar boat like India when we look at the valuations in US. I think when we study individual companies, I think we still find decent opportunities even from a value perspective. So I think that's why I would also say that it's probably not a great idea to completely shut out from US market even at this juncture.
Sure. Apart from India, India is a very attractive market. We think in India, see it patriotically, say it, obviously from longer term perspective, we have more comfort because of our understanding and relatively less comfort with other foreign markets. But apart from India and US, what is the third market that comes to your mind which you think is attractive and maybe one should learn, and one should not see it kind of or ignore it, and one should kind of see it with more data and learning?
I think it's a tough question, to be honest, because I see many other countries having maybe one or two great companies or maybe a few more, but not so much breadth and depth as these two markets offer. In fact, that relates to my decision, to focus on India. Having looked at global markets earlier, is that I saw such a great breadth as well as depth in opportunity set in Indian equities. I think some people like the segments of Japan market. Japan still has a lot of interesting companies with niche technology that are in which they are global leaders. So some people like to look at that as well. And so if one wants to study that, one could be study. That could be one of the markets that could be studied. But outside of that, I think it's like you're going to find a few opportunities in every many other countries, but not like this kind of basically like a treasure chest of large number of companies to choose from in any other country that I can think of. Certainly not China.
Sure. I was about to ask that question, but you answered that already.
Well, I mean, China, the obviously large part of the Chinese market was state-owned enterprises, and then they, some great technology companies were starting to build prominence. But then I think somehow Chinese government, didn't like it. They saw maybe a threat to their kind of control, and they did what they did. And so I think that has punctured that story, in a way that I think will take some time to come out of.
Sure. So this is the last question, Bhavin, to you. And obviously, we are here in this business of selling dreams to our clients of wealth creation from investments over longer term. And we are fortunate to maybe now convincingly believe that we are sitting in time and era where it looks like confidently I can say that next 5-7 years are going to be positive for Indian equity markets. And all of us more or less agree. You also agree with it. But for investors, and if I put myself in investors' shoe, to actually implement and maybe take full advantage of the potential possibility, it is important to understand from the success of someone who has had that participation into the bull run in the past. Now you, because of your 3 decades of experience and having delved into equity markets, and I'm sure your personal investments and wealth has been created through equities. So this is the last question to you, where we want to understand your story. And obviously, it is like successful investor story, trying to provide some vision and perspective to an investor who may be just, kind of waiting on the sidelines and being, worried about the market levels, and has missed the participation when market was going up, and now may again miss when markets are falling. So obviously you have come over all those factors and then have kind of learned and succeeded. So we want to kind of, learn from your story in this context.
So, I think there are some very, time-proven concepts of investing. That I know when I first, started looking at equities more closely, and I'm going to put aside the dabbling with Indian IPOs in early 80s, where I think one had no idea what kind of companies we were subscribing to, and there were a lot of kind of more misses than hits. When one invests without any proper analysis. I think my sort of more serious experience started with when I was in US, and some of it was doing direct equities in the sector I understood because I was working in a tech industry. So I started buying some tech stocks. And I think the analysis level in terms of understanding of valuation was very basic at that point. But maybe the understanding of the strength of a company was a little better. And I think the timing was quite okay. So I think in a way you can say you're lucky to start participating in that environment. But I think then at the same time, I also studied the concepts of dollar cost averaging and index investing. So I think if for anyone starting in the market, those concepts are very important. So in India we call it SIP, systematic investment plans. We in our PMS we do systematic transfer plan. I think if you're new to the market or a little concerned about it, that is the great way to invest. And I think if you're uncomfortable, or you're not sure how to select a fund manager, some bit of your money can definitely go in an index fund as well, because at least you start to experience the market that way. The most important thing is to experience the market, and I think kind of go through at least one cycle without risking too much capital in one go. Because I think chances are that if you do that, you will probably earn some returns, maybe not phenomenal returns, but very unlikely that you will lose money. And I think the other important thing is to have patience. If you are following some kind of a systematic investment plan, give it time, and presuming that you at least have taken the right advice to select the right funds. I think if you give it time, it will definitely work. That is my experience. And I think if you have time and energy and some ability to analyze, go ahead and do the direct investing as well. But my view is that I do it only when I have time to do it. I mean, if I'm able to devote full time to it. Otherwise, I think the results can be very mixed. So that's my take. And I think staying in the equities market over long period definitely is the key to kind of building wealth. Is obviously, it goes without saying.
Thank you so much, Bhavin, for sharing your insights. And it was quite interesting conversing with you. And to all our viewers, thank you for joining for this webinar. And I would say that we at PMS AIF World kind of always aspire that our clients make well-informed investment decisions. Our website, offers plethora of knowledge, and be it any topic about equities you are thinking about. If you have any doubt, be it valuations, be it growth, or be it any story of any investor or any fund manager, you will find all answers on our website. Or you may kind of log on to our YouTube channel, PMS AIF World. Our endeavor is that our clients kind of ultimately start the journey quicker and be on that journey for long term and participate in maybe one of the best rallies which we kind of see in front of us. And obviously, for your fine choices that you want to make and investment decisions that you want to make in this space of PMSs and AIF, which is definitely not a simpler space to analyze. We have a lot of data, a lot of insight, not just in terms of performance, but also in terms of the underlying portfolio, as well as the risks. We call it as quality, risk, and consistency analysis. Nobody in this industry, be it the largest wealth management firm, have this data. In fact, they take this data from us. But we kind of welcome you to book your appointment with us, and we'll be happy to help you in your investment journey in making well-informed investment decisions. We are already associated with more than 400 ultra HNI clients in India and overseas, and we are kind of already serving clients across 7 countries and obviously 25 cities in India, and look forward to serving you. Book your call, book your appointment with us. And absolutely, we are going to continue our rhythm of Friday webinars to impart this learning as well as knowledge to all our clients. Thank you so much for joining us for this webinar. Thank you, Bhavin, for your time.
Thank you, everyone, for listening, and thank you, Kamal, for hosting.
My pleasure.